Hi and welcome to Westpac London's end of day for Friday, August the 5th. And I've got to say, it's the end of a long day and a long week. We're all feeling pretty bedraggled. I'll run through the day's moves on stock markets first to give you a feel for how the session traded in the Northern Hemisphere, basically in 4 steps. Initially, European markets opened down, a couple of percent down in some cases, reflecting the sell-off that took place in the US market yesterday after Europe had closed. But that was really just catching up to where the US was. There was no fresh news driving that weakness. The markets were, but everyone was waiting at that stage for the US jobs report for July, and that actually came in a bit better than expected. We saw a 117,000 increase in payroll employment in July, and the unemployment rate fell from 9.2% to 9.1%, and there were some upward revisions to the May and June numbers. Even so, there's still a very clear slowdown taking place in the labour market according to these figures. I mean, the average pace of jobs growth in the 3 months was it February, March, April was 215,000, whereas now in the latest 3 months only 72,000. So the pace of jobs growth in the US has slowed by 2/3 in the latest 3 months that we've got data for. It's just that the figures aren't quite as weak as they were looking when we had those very soft May and June prints. So that gave the market a bit of optimism, and so we actually saw, once the Dow opened, an hour or so after those figures, it traded up 150 points. However, that optimism didn't last long. I think investors recognised that one jobs growth number, a little bit stronger than expected, really doesn't turn the story around. And we subsequently saw a 400-point drop in the Dow as concerns about US economic weakness and the sovereign situation in Europe continued to weigh very heavily on investors. The 4th stage, though, was a rally in stock markets, which occurred on reports coming through, which I think are almost now being confirmed, that in exchange for economic and financial reforms in Spain and Italy, the European Central Bank will step in and buy the bonds of those governments, thereby putting downward pressure on yields. And certainly yields on Spanish and Italian bonds did fall sharply. Spanish bond yields peaked from a peak of 6.37% today, ended the session at 6.04. That's a 33-point drop in the yield there. And in Italy, we saw 6.35 down to 6.10. So, you know, a 0.25% drop there in the Italian bond yield. So those reports certainly helped push bond yields down, and they also seem to have given, as I'm speaking to you now, the market a little bit of optimism that maybe something more is being done about the problems in Europe. Now, it's currently in London 7:20 at night. US stock market's got another hour and 10 minutes to trade, so anything could happen, but that's pretty much where we are at the moment. In terms of other markets, on the commodity side of things, we have still seen some pretty steep losses. For example, copper prices are down 2.6% today. We've got oil prices, actually oil was up 0.3%. Oil prices now $86.87 a barrel, but still way down on where it was just a few days ago. And gold prices down very slightly today at $1,653 an ounce. On the currency markets, the Aussie dollar traded a much narrower range today. Remember, it plummeted from 110 at the start of the week to around 104 yesterday. It dipped to as low as 103.8 against the US dollar today, although in the last hour or two it's picked up slightly. It's at 1.048 now against the US dollar, and that's on the back of this renewed hope that maybe at least the ECB is going to do something in exchange for economic reforms in Spain and Italy to help resolve the situation in Europe. I've got to warn you, it's not going to be enough, of course. Investors are going to cling to whatever hope they can. In a sense, at Westpac, we're sad. Well, it's good to see views kind of adopted by the rest of the market. We've been very pessimistic on the US economy for a long time. We've been consistently arguing that there ultimately would have to be a default or restructure of the debt of several governments in Europe. Markets are now coming to that realisation, and it's satisfying to see your view become mainstream when you've been right on the outer edge of the consensus for a long time. It's just a terrible shame, of course, that in the process of doing that, markets erase so much value. Pension funds lose money, investors lose money, and it causes economic uncertainty and all that goes with that. So a bit of a, just an observation to make at the end of a week when I'm really very, very tired. All right, I think that's about it. Look, next week's another week. There's more data coming out then and stuff. It's not a particularly major week, I don't think, off the top of my head. Oh, yes, it is. FOMC meeting. The Federal Reserve is meeting, of course, next week. What will they say? What will they say in their statement? There's no press conference with Ben Bernanke, the Fed chairman, but we will get the statement, which presumably, surely, will allude to the weak growth story that's coming through in the US and may hint at something that the Fed might do down the track to help avert the situation from becoming even worse. Okay, but look, let's leave it for now. Have a great weekend. Speak to you next week.